cryptocurrency has been a hot topic in the financial world for several years. Still, its adoption by governments and financial institutions has been slow. There are many reasons for this hesitation, ranging from concerns about regulation, volatility, and cybersecurity risks to lack of understanding, limited acceptance, and potential for fraud. In this video, we'll explore 20 reasons why governments and financial institutions are hesitant about cryptocurrency and what this means for the future of this emerging asset class. 1. Lack of regulation. Cryptocurrencies are not yet fully regulated in many countries, which can create uncertainty for governments and financial institutions. For example, in the United States, the SEC has not yet provided clear guidance on regulating cryptocurrencies, making it difficult for financial institutions to invest in these assets. 2. Volatility. Cryptocurrencies are known for their high volatility, making them risky investments. For example, the value of Bitcoin has fluctuated wildly in the past, with prices reaching over $60,000 in April 2021 before crashing to below $30,000 just 2 months later. 3. Cybersecurity risks. Cryptocurrencies can be vulnerable to hacking and cybersecurity risks, resulting in significant investor losses. For example, in 2014, the cryptocurrency exchange Gox was hacked, resulting in the loss of 850,000 bitcoins worth around $450 million. 4. Lack of central authority. Cryptocurrencies are decentralized, which means they are not controlled by any central authority or institution. This can be viewed as a threat to the traditional financial system built on centralized institutions like banks and governments. 5. Criminal activity. Cryptocurrencies have been associated with illegal activity, such as money laundering and ransomware attacks. For example, in 2021, the Colonial Pipeline was hit by a ransomware attack, and the hackers demanded payment in Bitcoin. 6. Limited acceptance. Cryptocurrencies are still not widely accepted as a means of payment, which limits their usefulness as a functional currency. For example, while some retailers accept Bitcoin, it is still not widely used as a payment method for everyday transactions. 7. Lack of understanding. Cryptocurrencies are still not well understood by many people, which can make them appear mysterious and risky. This can create uncertainty for financial institutions and governments, which may hesitate to invest in or regulate them. 8. Potential for fraud. Cryptocurrencies can be vulnerable to fraud, such as Ponzi schemes and fake ICOs. For example, in 2017, the BitConnect cryptocurrency was shut down after being revealed to be a Ponzi scheme. 9. Environmental concerns. Cryptocurrencies, particularly Bitcoin, require significant energy to mine, which can contribute to climate change. This can concern governments and financial institutions increasingly focused on sustainability. 10. Competition with traditional financial system. Cryptocurrencies represent a potential threat to the conventional financial system, which can create resistance from financial institutions and governments. For example, some central banks have expressed concern that cryptocurrencies could undermine their ability to control the money supply and maintain financial stability. 11. Lack of transparency. Cryptocurrencies can be challenging to track and monitor, making them susceptible to illegal activities. For example, cryptocurrencies like Monero and Scash use advanced encryption techniques to hide the identities of their users, making it difficult to trace transactions. 12. Tax evasion. Cryptocurrencies can be used to evade taxes, which can concern governments. For example, in 2020, the IRS in the United States sent warning letters to thousands of cryptocurrency holders, reminding them of their tax obligations. 13. Lack of insurance. Cryptocurrencies are not typically insured, making them risky investments. For example, if a cryptocurrency exchange is hacked, investors may lose their assets without recovering them. 14. Lack of recourse. Cryptocurrencies are not backed by physical assets or government guarantees, making it difficult for investors to seek legal recourse if something goes wrong. For example, suppose a cryptocurrency investment turns out to be a scam. In that case, investors may have no way to recover their losses. 15. Lack of scalability. Some cryptocurrencies, like Bitcoin, have scalability issues that can limit their usefulness in large-scale transactions. For example, Bitcoin's blockchain can only process a limited number of transactions per second, which can lead to delays and higher transaction fees. 16. Lack of standardization. Cryptocurrencies are not standardized, which can confuse investors and limit their adoption by financial institutions. For example, there are thousands of different cryptocurrencies, each with unique characteristics and use cases. 17. Lack of interoperability. Cryptocurrencies can be challenging to integrate with traditional financial systems, limiting their usefulness as a means of payment. For example, while some cryptocurrencies can be used to purchase goods and services, they may not be compatible with existing payment systems. 18. Political opposition. Cryptocurrencies can be viewed as a threat to political stability, leading to government resistance. For example, in 2019, the Chinese government announced a crackdown on cryptocurrency mining, citing concerns over its impact on energy consumption and financial stability. 19. Market manipulation. Cryptocurrencies can be susceptible to market manipulation, creating instability and eroding investor confidence. For example, in 2018, the U.S. Department of Justice investigated the possible price manipulation of Bitcoin and other cryptocurrencies. 20. Lack of customer support. Cryptocurrency exchanges and wallets can be challenging, and customer support can be limited or non-existent. This can create frustration for investors and limit their adoption by mainstream users. For example, if an investor has trouble accessing their cryptocurrency wallet, they may have no way to get help. As the use of cryptocurrency continues to grow, it's clear that benefits and challenges are associated with this new asset class. While some governments and financial institutions remain hesitant, others are exploring ways to regulate, adopt, and integrate cryptocurrencies into their systems. As this industry evolves, it's essential to stay informed about the latest trends and developments and understand the risks and opportunities of investing in cryptocurrencies.